Hi, everyone. This is Jason Bierak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Merry Christmas and a Happy New Year to everyone. Normally, instead of our interviews, what we're doing now is last year we had Rahul of Alt Investors Cafe, and on his channel we did kind of a roundtable with Mo Dawood, John Manfreda, and myself, and that was pretty popular where we interacted, all four of us. This year we're going to do it, and we're going to record it on our channel with Rahul from Alt Investors Hangout. So thank you for joining us, Rahul.
Jason, thanks for having me on.
Great. Now, Rahul, we had a very interesting 2014, but I don't know all of your predictions. I remember being on your show. I don't remember which interview we did on your show this year, where it was, but you kind of thought the stock market was a gigantic bubble and it was going to crash. And I admitted clearly it's a bubble, but I was like, they're not going to let it crash. So what do you think, in your opinion, has happened in 2014 with the asset markets?
Yeah, let me go back to what I said. I said that, in my mind, like a year back, that I felt that the stock market would correct around 25 to 30%. So I was looking at a Dow range of 11,700, and I was looking at the biotech index and also the social media stocks to crash the hardest. But what happened this year, and why did the stock market go up? Well, I was looking at this chart, and this is what traders like looking at as well, is this dollar-yen chart. So, long story short, we know that the dollar yen was 105 last year. This year, it's going to close around 119, 120. We're going to see how it closes tomorrow. So, we've seen roughly a 13% depreciation of the yen versus the dollar. That being said, you have to look at what this dollar yen does. This dollar yen basically takes the yen, and you could use this currency, invest it in higher interest rate currencies such as the U.S. dollar and their markets. So you're seeing all this liquidity going into the U.S. stock market. I'd say that the stock market has nothing to do with fundamentals. I think that you would agree as well. But the only reason why we see higher equity prices is not because of earnings. It's just because liquidity coming from the Bank of Japan. So that's why we're at a higher Dow.
I don't think it's just Japan. I think it's flight capital from China. There's rich Chinese people who are taking their money out of China, either out of Chinese real estate or out of Chinese stocks, and they've gone into the U.S. stock market too, or they're in the U.S. real estate market too, or in the bond market for the U.S. maybe just for short-term liquidity purposes. But from my contacts in the real estate industry, there's an enormous amount of buying of real estate by Chinese, whether it's in Canada or in the United States, in the major cities. And, I also think it's out of Europe too. I mean, Europe is such a basket case. It's had socialism for so long. And they've had socialism, too many stupid rules and regulations. It's very difficult to start a business and get it going in Europe. I've heard just so many stories of corruption and having to pay different fees and permits and things like that. Like, you're so far in the hole as an entrepreneur just trying to get a business up and going that it's just a barrier to entry. And then in France, you can't even fire anyone if your business is about to collapse to save your business. So I think there's been a lot of flight capital. The yen carry trade's one. I spoke with a hedge fund manager, Rahul, and he told me that the aggressiveness of so many different other hedge fund managers he talks to, that it's not just the yen carry trade. Any currency perceived as weak. So what could, with the Russian ruble collapsing so much lately, there could have been a ruble carry trade. So it's not just the yen is obviously a very big currency, but these hedge fund managers are just so aggressive. Excuse me. They're just so aggressive, and they're playing with other people's money, and there's really very little there's so much moral hazard there that they're willing to do these highly leveraged trades, and the worst thing is they get fired. They're not going to end up in prison. So it's not just the yen carry trade. I think the yen carry trade is a big part, but no fundamental, in my opinion, for the general stock market rising. I could give you at least 6 different reasons, very large reasons why the stock market shouldn't have risen, yet it did.
I think a lot of people were predicting a stock market crash because they thought that when the Federal Reserve ended QE, that could be a catalyst to where the stock market would start going down, but that didn't happen. We did see a correction in fall when the Dow Jones went from around 1,700 and it collapsed about 1,000 points or so. So we got about like a 15%, 10% correction there. But other than that, we didn't see a crash that everybody. Even Mark Barber predicted a crash, and it just didn't come this year.
Yeah. Well, one reason I think it didn't crash was not just because of flight capital, but the Fed's still reinvesting the interest it earned. So it hasn't like fully tapered and fully stopped buying back. It's still reinvesting its securities and reinvesting all the yield it gets from it. So, and you could also tell the flight capital because one thing I saw on a S&P 500 chart was there's huge bid orders at 3 in the morning, and generally that could be attributed to one or two things. One, maybe the Fed's buying during thinly liquid hours to push up the market, but it also is when, around the time Europe opens. And Europe, that's flight capital bidding up, and the S&P 500's been generally the bigger winner in terms of percentage gains.
Yeah, those are all good points, guys. I mean, we don't know if it's the plunge protection team or the exchange stabilization fund or the President's Working Group on Financial Markets. The ESF or Exchange Stabilization Fund has been around since 1934. And, they've been involved in markets. It's very opaque, no transparency. We don't know how much. And then Ronald Reagan installed a second group, a second plunge protection team. So there's really two. And then Zero Hedge reported this year also that central banks were getting a discount from the CME, the Chicago Mercantile Exchange, to trade futures contracts and things like that. So clearly the central banks are trading in these markets. We don't know how much. Even Draghi, right? Mario Draghi said, basically for their QE program, he's willing to buy anything but gold. So I guess he's willing to buy then indexes or ETFs. I think the Bank of Japan, their central bank has already done this stuff with their asset markets, has already started to try to prop those up. And it looks like these central bankers are just committed to asset price inflation. In nominal terms, at least. And the funny thing about this, guys, I had lunch with a local businessman. I won't name his name. I may work with him in the near term. He's a pretty nice guy, but he's an Ivy League guy. He has 2 master's degrees. One of them is a master's in economics. He has a successful business. He deals with institutions and hedge funds. And we were having a business lunch a couple weeks ago. And we were just talking about the markets and the economy and things like that. And he obviously did very well in school for himself if he went to Yale, and he's refusing to acknowledge that asset price inflation is inflation. And I can guarantee you that almost every single Keynesian out there that has been trained in the way that went to an Ivy League school and did well in business school or in their economics classes, they don't see what we see. They don't see reality. So they see asset price. They don't care about the wealth effect or financial repression. They don't care. They don't see asset price inflation as inflation because the CPI is not going higher. As we know, or at least I think most of us will agree here, that the CPI is doctored to hide inflation. So it's just really funny that they don't count asset price inflation as inflation, even though it's getting their wallets richer because a lot of these guys are managing money.
Yeah, they don't count anything. They won't count home prices as inflation, the bond market, stock market, because that actually correlates with a fatter wallet for Wall Street. So they won't count that as inflation at all. They'll count oil prices as inflation, but the reality is that's not in the CPI, and either is food. So the two biggest pain of inflation, they're not even factored in.
So go ahead.
Good point, John, about that. They remove food and energy, right? Normally from the inflation statistics, John, but now that oil is going down, they're saying how deflationary it is, right? Yeah. Even though they don't count it. I think that's just ridiculously hypocritical for them. So they count it when they want to, when it makes them look right, and they don't count it when it makes them look wrong.
Yeah, well, they don't acknowledge anything if it can make it look wrong, like the oil prices. They talk about what a stimulus it is, but they don't talk about how the number one state for job creation, which was Texas, they're going to lose a lot of jobs. North Dakota, which had the largest gains in terms of percentage-wise, they'll lose a lot of jobs. And they also don't want to talk about how natural gas, a lot of the production was a byproduct of shale oil production, and that's why we have cheap natural gas, that if these oil prices stay for a while, natural gas prices will go up, and then your utility bills will go up. So,
speaking of asset price inflation, I'm at Doug Short's website right now, and I'm looking at the federal loans to students, and basically what we can find out from this article is that, number one, the largest assets on the books on Uncle Sam's balance sheet are student loans, and it has increased 614% since 2007. So it was, I think, $115 billion, and now it's $825 billion. So another example of asset price inflation, and that's another way to show that the Keynesians are definitely wrong about asset price inflation, because you continue to see higher student loan prices, which are going to screw the young people over.
Yeah, I think our generation, they're going to have to be entrepreneurial. They're going to have to learn to add skills as cheaply and inefficiently as possible, because a lot of employers, and I talk with some of them, who listen to this podcast, small business owners, they don't want to hire a lot of people out of college normally, because, yes, they have a paper degree, but a lot of them don't have the right skills or the right experience, and they don't want to pay someone full-time for on-the-job training. I mean, the days of full-time paid on-the-job training, those are long gone. I think people are going to have to. Unfortunately, it's a difficult economy. I mean, the mainstream media is trying to sell people on the illusion that the dollar is strong, there is no inflation, the economy is recovering, GDP is growing, these types of the unemployment rate is getting better, these types of things. But when you dig down into the data, or you actually ask people on Main Street, there's a lot of people who are just graduating college. They're desperate to find a full-time job, and they can't find one. They're lucky if they find one or two part-time jobs, if that. And normally it's not in their field. They're getting paid a lot less money, and this is very common. So I don't think the data now, John, you look at the data more than I do. I think the employment data, it's counting part-time jobs as full-time jobs. Now, they're just you mentioned one of the tricks they're playing already with GDP and some of the other data. They're trying these game points to go on mainstream like the Bloomberg or CNBC and tell people, that things are good, sell them hopium. But the reality is that like almost all the jobs that were created, I think, since 2009 were almost all shale oil jobs. All the full-time jobs created in the United States were almost all in North Dakota, Texas, Oklahoma for full-time shale oil jobs, and now those jobs are in jeopardy. Almost all the other jobs that have been created were not full-time jobs, they were part-time ones.
Yeah, they're even counting temp jobs, which is like 6 months. 6 months or less as a job created. So, yeah, the only industry that has a net gain, a significant net gain since 2009 or 2007 actually, is the oil and gas industry, which is over 40%. I think it's 43% to be precise.
I think a lot of the shale oil producers in Texas and Dakota are very worried right now with the oil prices being so low, because a lot of them can't even make a profit or break even at today's price at $60. So I think a lot of them are on edge now. So I think we'll probably see an increase in unemployment in the near term, even though the unemployment number is doctored as well, just like the CPI. So we'll see. Maybe the government will change the rules on that one too. But another asset that popular asset that the government is trying to put more inflation in is the real estate. And if you guys may or may not know, the recent announcement is that Fannie and Freddie Mac are rolling out a program where people can put down 3% down payment for a mortgage to buy a house. So I know the government is putting more emphasis on trying to reinflate put more upward movement on the real estate prices like they did before the financial crisis in 2008.
Yeah, I was going to say there is actually signs of the housing market. The new home sales numbers were bad. Today's numbers of the Schiller's home price that missed expectations, and first-time home buyers is at 40% low, or has decreased by 40%. So the housing market, that has not looked good from any spin doctor you could put on it. In fact, the only real good data I found was permits and startups, but that doesn't mean sales. So if you ask me, like, permits and startups don't mean anything. It's sales that matter.
Well, to add to your point, John, also what the developers, because they have cheap capital, right, and the developers know that they're probably going to get bailed out by Congress or the Fed because it's a policy goal, is these guys are going to build that stuff on spec. So normally, if you were going to be a prudent housing developer, you wouldn't build the house or the condo or any of those buildings unless you had guaranteed tenants for them. So you got like a long-term contract or you pre-sold the units. But they're doing the exact opposite. So they're building all these units, and then they're hoping to sell them afterwards, which is very risky, but they're not using their own money. So if they were using their own money, I could guarantee you they would be prudent, but most of these guys are not using any of their own money. So they're using, the subsidized, cheap bank money or Federal Reserve money or whoever they can borrow, Fannie and Freddie. And, it's creating asset bubbles. It's creating bad investment decisions in the market. And, that's something else I wanted to talk about besides the real estate market was the interest rates. One of my 2014 predictions, I thought interest rates would spike briefly because in 2013 we had a scare where interest rates spiked briefly and then crashed again and then went lower. I thought interest rates would spike again and then they would be a desperate attempt to drastically lower them. But it appears that no one in the developed world, whether that's Japan or Europe or the United Kingdom or U.S., can really allow interest rates to go quite a bit higher for any period of time at this point. So it appears that all these developed world economies are all in on financial repression. So I was wrong about that. I didn't study financial repression nearly enough. For our listeners out there, Gordon T. Long does a great job over on his channel. He talks a lot about financial repression. I really follow his work closely. He does probably the best job of anyone on the internet about the ramifications of financial repression. So we're in a situation here where just to keep the game going, to keep asset prices higher in nominal terms so governments can continue to borrow as cheaply as possible because they can't pay their interest payments, especially Japan. Japan's like the worst case example of this because Japan really can't pay even a 1% increase, I think, on their interest rates. So all these developed world countries are all committed to financial repression. So I don't think anyone in the developed world can afford, like any government can afford higher rates, them or their banks really.
What's the crazy part about Japan, their 10-year yield is 0.33, which is quite incredible, with a debt to GDP over 200%.
And their inflation, so they're getting negative return on if anybody buys the 10-year bond.
No free market in their bonds, Rahul. If you study Austrian School of Economics and learn about financial repression, you shouldn't be surprised about what's happening with the yield on their bonds. They're not allowing bond vigilantes or bond traders. They bought all of them off. So the bond traders who normally work at Japanese banks, they're not allowed to short the Japanese bond market. They're not allowed to go in there and do that. They're probably forced to buy even more bonds. I mean, the Japanese government has bailed out the Japanese banks. They didn't have to write off their assets when their asset markets crashed in the late 80s, early 90s. So they're not allowed to short their own bonds. So it's just a really interesting scenario. I think the best case scenario for the U.S. is to try to muddle along like Japan. And have like a controlled amount of stagflation and lie about it, but I don't know if the U.S. is going to be that lucky. Japan was really the only one doing this for a while, and now like almost everyone's trying to do what Japan did. It's just freaking nuts because if you look at interviews from Ben Bernanke and these other central banks, they're like, "Oh no, we don't want to be Japan. We won't do what Japan did." But look at their behavior and not what they're saying. So they're doing what they're trying to do what Japan did.
Yeah, the central bank and government are pulling out all the stops to try to keep this game going. So I think one of the biggest surprises I've seen in 2014 in the market and the economy that Belgium is now the third largest buyer of treasury bonds. So we're talking about a country with a GDP of over $100 billion in euros now has over $400 billion in U.S. dollars and counting. So they're the biggest buyers in 2014.
They can't sell that much Belgian beer and Belgian chocolates and Belgian waffles, Mo.
I guess not.
They're good, but they're not. You got to mass produce them, so.
So I think that's one of the biggest surprises I saw in 2014. That Belgium is now the third largest treasury bond buyers, and then also talking about
you know who's in fourth place?
Who?
Caribbean Bank Centers.
Oh, that's like an offshore haven for the Fed.
Yeah.
Yep.
Yeah.
Well, I mean, the Belgium thing, guys. Who even did you guys even see this mentioned once on CNBC or Bloomberg or on CNN or the regular news? I haven't heard it or seen it mentioned once. It's just
I read an article actually about Bloomberg. They claimed that
Bloomberg did.
China's buying and storing them there, but who knows? I personally think they just have a deal with the ECB, but I can't prove that.
I think, yeah, it was probably a currency swap, and they're stashing them there. I mean, there's so many currency swaps. That's something we've covered in our work. You're starting to see this now. The RT just did a story about another Chinese-Russia currency swap going into effect, and I think China already has 20 different large currency swap agreements, multi-billion dollars. Those are all they put out in the press release. They might even be more than that. And, these countries, so whether you're a developing country, you're Canada, you're Brazil, you're Russia, you have U.S. dollar denominated debt, and when the dollar has gotten stronger this year, that's become onerous. So India's had a lot of problems paying off their dollar denominated debt in a drastically weakening rupee. But, if you have a currency swap with China and China picks up the slack, you may see, I'm not making this as a prediction like any in the near term, but, over the next decade or so, or maybe even sooner than that, you may see these guys, what they'll do is their U.S. dollar denominated debt that is owed to U.S. banks. You may see some of these countries or foreign banks that are backed by foreign governments in developing countries that have done currency swaps with China, you may see them start to default intentionally, strategic defaults, walk away on U.S. dollar denominated debt, just activate their currency swaps, right, and start paying a lower interest rate, maybe in Chinese RMB or something like that, just to not only would it be lower potential interest payments to maybe Chinese banks on better terms with the new Chinese financial system that's going to be put in place, but it may also be a middle finger to the U.S., flipping them the bird, saying we don't like the stuff that your government's doing, your military's doing, what your regulatory agencies or corporations are doing with some of these compliance acts and things like that. So we could see that in the future as the world transitions away from the petrodollar and the dollar as the world's reserve currency. That could be something to think about then, that these currency swaps could lead to developing countries with a large dollar-denominated debt that's really onerous. They could strategically default in the near future on those.
That's an interesting theory. I see China and Russia becoming more and more close friends as the U.S. further separate themselves between Russia, and that currency swap is one of the moves that those two countries have been making between themselves. And with the kind of move, it seems like they're trying to set up maybe their own little world reserve currency or another alternative basket of currency reserve instead of just holding U.S. dollars mainly.
Well, they want to get I think the main point is that they want to get back to normal regular trade. The normal regular trade, Mo, is where I produce goods and services and you trade me goods and services, and we make some mutually beneficial stuff. But the way the world financial system is set up now with the petrodollar and the dollar as world reserve currency is these other countries, whether it's Japan producing Sony making equipment, or Honda or Toyota, they're working their butts off to produce products, right? And then that requires a lot of work on their part, and then the U.S. just prints more dollars. So the U.S. isn't producing any more goods or services. The U.S. is just printing more dollars, and the other countries are busting their butts. So it's not real trade. The U.S. is just basically just printing dollars in exchange for goods and services.
Yeah. Well, going to the China-Russia, they announced that $150 billion swap, and part of it, I think, is they're bailing out Russia because China has huge amounts of energy trades with Russia, and China has a big demand for energy, and they don't want to, if there is a collapse and a potential uprising in Russia, like there is hyperinflation, China will suffer from it. So it's in China's interest to help Russia out.
I agree. So one of the other biggest surprises in 2014 is the oil prices collapsing. I don't think anybody saw this coming. I know a lot of countless other energy investors and experts did not see oil prices going from around the $100 trading range to all the way down to $50 to $60 trading range today. So that's probably the number one surprise for me in 2014, seeing the oil prices come this low. And there's a lot of interesting theories on why the oil prices collapsed. A lot of them saying that Saudi Arabia did this on purpose to punish Russia, Iran, and Syria, and ISIS. But there's also a lot of other theories out there as well.
Yeah, there's a lot of theories. The mainstream media theory is that Saudi Arabia is going against the U.S. shale production and that they're defending their market share. I personally think it's obvious that this is obviously a financial warfare, and it's called the oil weapon. It's been used before. OPEC used it on the U.S. in '73 for their to support the West for supporting Israel, and then in '86. Saudi Arabia used it on the USSR, and that was to collapse the USSR because most of Russia's revenue comes from oil exports. And of course, '97 oil went down to $12, and that led to Russia having to default on bonds. So it's been used before, and I think they're just rehashing an old play in their playbook. I think it could be. I think Saudi Arabia, though, has multiple reasons. Obviously, they want to defend their market share. I think that's one, and I think the Saudi Arabia doesn't ratchet up production, though, without the U.S.'s permission, generally speaking. So I do think this was also a way to punish Russia. So, but it's caused unintended consequences.
Yeah, I think for sure, guys, the oil price did not fall because of fundamentals. I mean, I just saw this really visual capitalist posted this oil article, and there was a video from it from CNN Money, and it was talking about the U.S. oil producers produced too much supply and flooded the market with supply, and demand decreased from China enormously from China and from Europe, and that's why the oil price fell. And I saw that video today before we started recording, and I was like, they could not be so wrong. They're trying to, put two fundamental points on the market exactly why. When the oil market is not a free market, OPEC is the national oil. It's a cartel. There's national oil companies that control the majority of the world's oil production and world's oil reserves. ExxonMobil, British Petroleum, BP, Shell, Total, Chevron. They don't control the majority of the world's oil production. It's Saudi Aramco and Iran and Iraq and Nigeria, and those guys are the ones who control the majority of the world's oil production still. So, there's always been geopolitical games in oil. The whole petrodollar system is a geopolitical game, right? So, it's just ridiculous, but the mainstream media needs a quick soundbite, right? So the average person who looks at their account value in 401k or their IRA spends 5 minutes looking at their statement every day, and that's all the research they do, so they won't question, why the oil price dropped. Oh, that's why. That's a good explanation. Oh, I'm not going to do any more research, but I think it's the oil market. I didn't see this crash coming clearly. I didn't see that coming. I interviewed a lot of energy experts. I did a lot of reading myself on the oil market. We all have, Mo and John have, and we didn't see it coming. None of the experts who have good track records managing money in energy and also with the energy market didn't see this coming either. But I think there's enormous opportunity here. I think oil, this drop for whatever reason, whether it's market manipulation, economic warfare, whatever, margin calls, I think there's enormous opportunity here as a long-term investor looking for, if you do your homework, for profitable companies.
Yeah. Well, mainstream press, I was going to say, didn't even deny that there's some sort of warfare going on with. They just didn't want to mention all scenarios. They just gave generic Saudi Arabia versus U.S. shale production. So.
And then the thing that the media didn't even talk about, I don't think even the alternative media is talking about, in my opinion, the Obama administration also wanted to have the oil price drop for a few reasons. You could see Texas as a haven for fracking, and from what I've read, Obama does not, or his administration does not like fracking, and the environmentalists don't like it. So that'd be a good way to put them out of business, as we could see with what's going on with the coal industry. And then secondly, it's to obviously get back at Russia, which all of you guys have talked about as well. And Saudi Arabia wanted the fracking industry to get destroyed as well.
Yeah, there's a lot of interesting theories on why this happened. None of these theories are right or wrong. We'll probably never know why this happened. But for investors out there, with this currency creates an opportunity. And right now, as Jason said many times before, this is the best time to buy oil stocks since 2009. So any investors out there that want to take advantage of this, or they're looking for yields, I think the energy stocks and MLPs are a good opportunity right now.
Yeah, there's evidence, guys. I don't know if you heard about this, but from WikiLeaks, from some of those documents that Bradley Manning got, and then he gave to Julian Assange, and it's talking about how the U.S. Had a multi-staged pronged attack on Russia, and one of the things they were going to do was destabilize Ukraine. I don't know if it talked about attacking the Russian ruble, but obviously that's part of the attack. Is the ruble started going down long before the oil price did, so the ruble's just been decimated before China stepped in with the enormous currency swaps there and helped shore it up. But
you know what's bizarre about that? About the plunge in the ruble?
Mm-hmm.
It's that the Russian ruble, I believe that currency, they're running trade surpluses from what I've read.
Oh, they've got a great fundamental. They have. I think they have $400 billion in reserves too.
Yep, and that currency is plummeting while the U.S. dollar is getting stronger. Deficit. Quite ironic.
Russia's actually hiking up interest rates too, which is funny because they're actually fighting for it. They're actually having a strong currency and taking actions to it. Meanwhile, the U.S. just says be patient with interest rates.
Well, interest rates are manipulated, guys. I mean, like, every government wants to manipulate rates. Keynesians don't want a free market in interest rates at all. No Keynesian, neo-Keynesians, none of these regular Keynesians or versions of Keynesians or Paul Krugman, none of them want a free market in interest rates. They pretend there's a free market in interest rates, but they don't want a real free market in interest rates at all. So whether that's the developing, our listeners can email us, wallstreetformainstreet@gmail.com, for my 10 pages talking about 2015. But basically, I think that if the developing world, if they could get away with it, they would be doing financial repression on their own citizens too. But a lot of them have dollar-denominated debt right now, and they don't have their currency swap set up for the next system, potentially. So I don't think they can do financial repression to the degree that Japan or the United States or Europe can do to their own citizens. But, ideally, they would, if they had the opportunity to do it, so they could continue to grow the government without necessarily collecting more in tax revenues and things like that. Financial repression is really a very favorable policy tool. It's been used throughout modern financial history. It was used even in the United States after World War II. Most people don't even know that because of how well the economy did, but the U.S. government used it to pay off war debt after World War II as well.
And yeah, so I don't think the government or central bank would like to see the stock market crash. I think they'll do whatever it takes to prevent that from happening, because that'd be counterproductive in what they're trying to do with financial repression and the great wealth transfer that they have going on right now. Because they need the stock market to keep going up for the tax revenue and just to keep the game going as well.
Yeah. Well, not only that, most of the assets on the bank's balance sheet is housing, so they have to keep housing market propped up. Otherwise, a lot of the banks will go insolvent.
The banks are holding an enormous amount of bonds too, John.
Treasury bonds, yeah. That's what they generally hold as a yield play. So that's what they do. And their
now
biggest,
the
I was going to say, their biggest costs are also, generally speaking, just from a banking institution standpoint, is the interest they have to pay on their depositors. So.
Yeah. Did you guys see the looks like the subsidy there that's coming for the derivatives market. So it looks like they're expecting some type of implosion in the derivatives markets, and the U.S. taxpayer is probably going to be on the hook because clearly the banks don't have the cash to pay off the derivatives losses. And I think they just snuck that into a bill in the last couple of months. One of these spending, I forgot what it's, the omnibus spending bill or something. They snuck in, like an oil derivatives losses are now on the hook. The U.S. taxpayers on the hook for that.
Yeah, they revised the Dodd-Frank Act and the $1 trillion spending bill a couple weeks ago, so that all the losses from the derivatives will be socialized. So taxpayers will be on the hook for that. And I think that Jamie Dimon was the main player in getting the senators and congressmen to get that provision in there. And he also went around threatening to telling the government to shut down the government if they can't get the provision in there. This showed you crony capitalism at its best.
These guys aren't free market capitalists because they don't want bankruptcy. They don't want to lose, their stock options and bonuses. They can play these games with earnings to move the stock market price higher, so it triggers their options and stuff. But in terms of 2014, some of our predictions, I think like the ones I got right, where I nailed the Japanese yen, what it was going to do. I nailed that. I said the stock market wouldn't crash. That wasn't a very popular view. Almost everyone said it was going to crash. Everyone in the non-mainstream media said it was going to crash. Almost everyone did. I think we're more headed towards a crack-a-boom personally. But if you want to read my full thoughts on the stock market, I typed them up for our 2015 predictions. So if I'm sticking with the same basic stuff. So if the markets do crash, we're allowed to crash, and I have very serious doubts about whether they'll be allowed to have any type of correction in stocks, bonds, or real estate. But I don't think they'll allow it for more than 6 or 12 months before they come up with a new type of quantitative easing or currency swap scheme or something else to trigger them higher. But I also nailed the copper price dropping. I didn't see the oil price dropping with the copper price, but I knew that China was slowing down, and that the demand for copper is more artificial and copper is recyclable, unlike oil, whereas oil is consumed. China actually still has an enormous amount of car sales, and people are not taking out car loans for the cars. So I think this oil correction is very painful, but I don't think it's going to last long term because China, all the cars that are coming off the road in the U.S. and Europe, China's basically putting a lot of them back on the road in China and in the other developing world areas, markets like South America and Middle East and Africa. These countries and India, these countries, like, they want to drive for the first time. And one of the best things about oil as an investment is it's not recyclable. So it's used up and then it's consumed and you have to get more of it. I really only had 3 good predictions that actually, in my opinion, really did well. The rest of them were not. A lot of them were focused where I was wrong, and Mo and John were wrong. I guess we're on commodities markets.
Yeah.
I will concede that really nothing for. Obviously, there was some shale oil companies that were in a boom up until the last, since June. But really, other than that, there wasn't many things on the long side working in the commodities markets really since 2011. But the cycle, I think we're going to have supply shortages, guys, in a lot of markets soon because demand, the markets, just penalize everything commodities, whether it's computer traders or all the deflationists on Wall Street, where it's, strong dollar, short commodities. I know so many traders on Wall Street who are strong, long dollar, short commodities. We're in a situation here where there's still real-world demand for food and energy and precious metals, and now there's supply problems in a lot of these markets.
Yeah. Well, we were expecting to see some type of upward movement in the precious metals market, and we didn't get that in 2014. Instead, we saw more painful correction, especially after the summer, where gold went to around 1,100, and then silver went below $16 at one point, which was a big surprise for everybody.
Well, we almost had a breakout, right? I think John talked about this in another interview I listened to, John, right? We almost had a breakout. You interviewed Jordan. Yeah, you were asking Jordan Roy Byrne about this from Daily Gold.
Yeah.
We almost had a breakout, and, they went in, the charts were about to break out, and then it looks like the smash down occurred. The cartel came back in and just started selling it and broke the charts again, painted the tape.
Yeah, I was going to say we almost had a breakout in terms of up until March, and then it was for the resource sector as a whole, doing pretty well. I mean, the ones, I would say energy and precious metals, palladium was almost to 1,000, and platinum was doing well. And I guess they painted the tape.
Zinc was doing well too, yeah.
And zinc was doing well. So I would say that. One thing, so I was wrong. I thought the resource sector would resume. I'm not sure. I think it will resume next year, but I don't know how. I think it could end up just being up marginally. I think that's possible. But the bull market resumes because it might resume sort of towards the end of the year when the Fed finally says no to raising interest rates. But it's possible it might go sideways, or it could resume in quarter two, or however it plays out. So it could be really a weird resumption, I think. But you never know. It's a painted market, so it could not. So I say that with caution.
What I find sorry to interrupt.
No, go ahead. I was done.
What I find interesting about the price of gold this year, suppose tomorrow, the last day of trading, it stays around where it is right now. I think it's $1,203 as of right now. It's going to be up almost 2%, while the U.S. dollar index has gone up. So that's one interesting point where many people would say, hey, the dollar's appreciating, and at the same time, the price of gold has still maintained its value. So that's not impressive, but that's a positive for gold bulls out there.
Well, the price of gold, too, Rahul, in other currencies is also up a lot. So in Russian rubles, the price of gold is up a lot. In Japanese yen, the price of gold is doing well. It's only really in the dollar where gold is measured, where gold is not doing well. But it's doing well in other currencies. So, I mean, that's not a good thing, though, if you're a U.S. investor, if you're holding mining stocks, or you're trying to make capital gains off buying metal. But, it's just showing, though, that other countries – that the gold is still doing well in those things. But my view
Go ahead. I'm sorry.
Yeah, my view for why the gold price has to either it has already bottomed or it has to bottom soon is when I look at real world supply demand fundamentals, the paper markets are a disaster the way they're structured. It's ridiculous. It puts so much pressure and burdensome on the miners. It's so ridiculous how much extra volatility adds for the miners. But you look at the demand for actual physical gold. You look at Kuz Jansen's numbers of Bullion Star, who I think does the best job of basically anyone on the planet looking up real-world demand out of China and Asia. And you look at the demand for gold and silver from India, China, on the Shanghai Gold Exchange. And basically the supply market for gold is really tight. I don't know how much physical gold the West has left, and I think almost all the mining supply is spoken for. So the markets are so tight, especially for gold and silver, that the mining supply is really crucial. And now we're at a point, guys, where I don't know how often, Rahul, you look at balance sheets, but Mojan and I look at these miners for gold and silver a lot. Most of them, like, they've cut the fat that they can cut, and we can list all the different expenses, but they can't really cut anything else without actually shutting down the mine, putting it on care and maintenance, selling the company to a larger company, or going bankrupt. We're at a stage here where, the metal is actually needed because the supply, in my opinion, is that tight, and the miners, a lot of them, I think, don't have 12 months left. I don't think most of the primary gold miners can survive $1,100 an ounce gold or lower, and for silver miners, I mean, they can't even survive $18 an ounce silver, let alone 16 or lower an ounce silver. It's crisis mode. The silver miners in particular, their financials are just in a lot of bad shape.
One of the surprising things I've noticed for 2014 is very little M&A activity in the gold and silver mining sector. I mean, recently we saw Paramount Gold and Silver get bought out by, what's the name of that company?
Coeur d'Alene.
Coeur d'Alene, yep. And other than that, we haven't seen that much M&A activity, and that's just a reflection on how short-term thinking the management team are for the gold and silver mining companies. So a lot of them are not thinking long term or the opportunity presenting to themselves where they could buy all of these good companies for pennies on the dollar. Instead, they're trying just to weather the storm and make it through and survive, and then maybe later they'll do merger and acquisition.
They'll be overpaying at the top.
Yeah, they'll be overpaying at the top.
Yeah, I think the seniors also are just not in great financial situations. They've done a lot of bad mistakes, and it's cost them dearly. And so buying assets is now expensive to them. I think that could be one of the reasons that there's not much M&A, because like Barrick, like the write-downs, and they're in Pascalama trouble. Newmont's not efficient. So the only real efficient senior is Goldcorp, and they're not willing to overpay. They did try to buy out Osaka, but Osisco, sorry. My pronunciation's bad. I just read. But Yamana came in and did Yamana and I believe,
was it Agnico?
Agnico Eagle. Yeah, you're right. Agnico came in. So
it was a joint venture. Yeah, it was Yamana 50% and Agnico 50%, right?
Yeah. So it is. I think part of it's just really bad management and puts them in financial trouble, so they're unable to. So. That's...
Well, all of the whole industry. I agree. The whole industry has basically been mismanaged. There's most of the companies, besides the royalty and streaming companies in gold and silver, which I think are exceptionally well run compared to the majority of other mining companies. But they have an easier business model though. But the regular miners though have just been so poorly run. But now like they're in survival mode, just where they can't raise any debt or equity. There's just none really available. So, and yet the metal is still needed. And so if the price goes any lower, we may the paper metals prices could go a little bit lower, but then the mines are going to blow up. The mines are going to get shut off, or mines are going to go bankrupt, and then that's it.
Well,
that'll be the bottom.
I think they have to go bankrupt, because once they shut them, they won't restart. I think they won't restart, and not only that, the government's going to lose a lot of tax revenue, unemployment figures, and they have to pay fines for shutting down. So they're going to do what they can just to survive. So if they shut down, that definitely would have to be the bottom, because they won't. It's very unlikely it'll come back on. Well, it might come back on, but it will take time. It might take 5 or 6 years.
Yeah, I mean the physical gold and silver markets are both very tight. So there's not a lot of excess supply available. I mean, there's a lot of above-ground gold, but most of it's spoken for, and it's not going to readily hit the market. So that's like something that gold bears use, the stocks to flow argument. But they're like, oh, at any point in time, all this gold, physical gold, could hit the market and collapse the prices. And the gold bears try to point to that, but most of that gold, is in very strong hands. A lot of it's in the hands of people in India and China who bought it for wedding anniversary gifts or jewelry, and they're not going to want to sell it. So it's in stronger hands than people think, and the actual the actual flow, the real supply demand of stuff, not the total above ground supply, just the flow argument. The flow is really tight, in my opinion.
Yeah, I agree with you on that one. So let's look forward to 2015 and talk about some of our predictions for 2015, and we'll talk about the precious metals market as well later in the podcast. So I have 5 predictions for 2015. I'll start off with one, and we can all share. You guys can share your prediction as well. And one of them is that the Fed will not raise rates in 2015. Despite what Yellen and the other Fed are saying, there's no way they will do that, because a 1% increase in interest rate will increase the federal deficit by $880 billion. A 5% increase will increase the federal deficit by $360 billion. So I don't think the Federal Reserve want to put extra pressure on the federal deficit on that either. Also, it will be counterproductive for them to raise rate, because right now we're going through a financial repression, and the central bank and government is doing a great wealth transfer where all the wealth is going from the middle class and channeling up to the 1%. So raising the rate,
and the government.
So raising the rate will be found counterproductive, and also will decrease any tax revenue coming in for the government, because a lot of the tax revenue come from capital gain and also the short-term trading that people do in the stock market as well. And with oil prices going down, I don't think the Federal Reserve will have any opportunity to raise the rate in 2015. So, what are you guys' thoughts on that?
Yeah, I don't think they can. Not only that, that could prick the bond market, and a lot of the banks hold the bonds as assets. In fact, some of them hold it, and once they get the yield, they use that to as partial payment to depositors on banks. I've been reading just a finance book on some of the things banks do recently, and so it would just the system can't survive higher rates, the banks or the government.
Same thing, guys, with the derivatives market. All these interest rate swaps, as Rob Kirby does excellent work on this, and Jim Willey does too. These interest rate swaps, hundreds of trillions of dollars in interest rate swaps were sold, betting by the banks that the governments would have lower rates. So if interest rates were to spike, these interest rate swaps would start exploding, which would lead to defaults because the banks can't pay off the bad bets. And then, we'd have counterparty risk and failure. Things would start triggering like dominoes. We'd have 2008 or worse with rising interest rates based on, what the banks have done in the derivatives markets. So, and they've, with the shale oil companies with rising rates, they've been financed with cheap debt. The real estate market, like John says, financed with cheap debt. The bond market, Mo, you said it's $180 billion for a 1% rise for the U.S.?
Yes.
Yeah, Japan, it's even worse. A 1% rise in the yen in Japanese government bonds in Japan would take up about 100% of their annual tax revenues. So we're at a stage here where these banks, not banks, these Keynesians in power, whether they're academic Keynesians or Keynesians in the financial sectors of each government or financial industry, and they've all decided, that we won't allow free market interest rates. We're going to keep the interest rates lower so the government can continue borrowing, and the rich people who have asset prices can make money off asset price inflation. Mo, you mentioned the 1% they're making money off this. It's not just the hedge fund managers or the investment banks or the large Wall Street banks. It's also the government for borrowing. It's the two. It's not just because, it's not just the private sector getting rich here. It's all the government programs and the welfare warfare state. You can't have a welfare warfare state and grow government without cheaper and cheaper money. It just doesn't work because the people won't pay higher taxes for programs they're not getting or don't want.
Yeah, I agree with you there. That's why I said that any increase in interest rate would affect their tax revenue, so they won't be able to fund their social programs, like you said, and their welfare and warfare state as well. So that was one of my predictions for 2015. Rahul or Jason or John want to share one of your other predictions?
I guess my real prediction, is that I think oil will bottom this year, just because there's so much capex spending now being greatly reduced. Canada, where it's Husky Energy, that reduced their capex spending by 1/3. They reduced their increase. Suncor is even reducing their capex spending, and that is one of the stronger balance sheets of the Canadian oil sector. Oasis Petroleum, they've reduced their capex spending by 50%. Enbridge, which is a pipeline company, they're not as sensitive. They've laid off 100 workers. Halliburton has laid off 1,000. BP has announced accelerated layoffs. They haven't said how many. So a lot of companies, Venezuela, they're on the verge of collapse. That's oil that could be potentially taken off the market completely if they go under. And Venezuela is also defaulting. They're not officially defaulting, but they're unofficially defaulting because they're not paying their airline companies for the bills they have. They're not paying for, they've delayed payments or not paid for imported food, and they've also done it for pharmaceutical drugs. Nigeria has suffered from this price. Iran needs around $140 barrel of oil. Of course, there's the problems with Russia. There's also problems, Russia, Iran. Let's see, Saudi Arabia is running the biggest deficit, so they can only play this game for so long. They've had their biggest deficit this year, and they've actually increased government spending this year to save their stock market, because a lot of people estimate with low oil prices they'll be spending less. So Saudi Arabia can't do this for very long. So I personally think the oil market with shale Canadian, and there's a lot of OPEC. Of course, Libya, they're having their problems. I think the oil market will find its bottom this year. How much it will resume, I don't know. It might not resume that much. So I think it will resume an uptrend, but it might find a bottom at 45 and then go up to 65. It might find bottom at 50 or where it is now and then just go up to 65. I don't know the exact bottom, but I think the bear market will end this year.
Yeah, if there was a free market in the oil market, I would expect a V-shaped recovery in oil prices. But since the oil market is manipulated with the oil cartel and the government in Saudi Arabia, I think the oil price will go sideways in 2015 and form a trading range between 50 and 70 for the majority of the year, and then after that resume back upward to their normal price around $100 before the collapse. Like I said, if it's a free market, it should go up today, because with the geopolitical events going on in the Middle East, with ISIS, Syria, Iran, with peak oil, with increasing demand in developing countries and currency wars, and the fact that many governments need higher oil prices to fund their fiscal budget, like Russia and Saudi Arabia and Iran, I don't see the oil prices staying around this prices forever. So I think it will go back up when. Really not sure, but I think my prediction is that it will form a trading range between 50 and 70 for the majority of the year. With that being said, like we said before, this is a great opportunity for investors out there to invest in oil stocks and MLPs, because there's a lot of attractive yield for investors hungry for yield.
Yeah, the prices have come down so much. We're starting to see a lot of bargain buying for people in the energy sector, oil and energy sector, agree with us. I think people are getting paid to wait. So if you're in an ExxonMobil or Chevron or a BP or a Total, you're getting paid, or a Royal Dutch Shell, you're getting paid to wait. Halliburton or Schlumberger are good oil service companies. I mean, they're going to be needed to do more drilling for oil production going forward. And a lot of these MLPs, the pipeline companies, they have very long-term offtake agreements for more than 10 years for pipelines. Some of the deep water offshore companies and the oil sands, those are higher production cost stuff. You'll get more leverage out of there, but if it stays lower for longer than we think, the Seadrills, the Transoceans, the Diamond Offshores, some of the Canadian oil producers, the higher cost producers could be in some trouble depending upon how much debt they have.
Yeah, I would say that's a stock picker's market. You'd have to really know what you're doing in those. Yeah,
so what I did was I just bought the OIH because it was really difficult for me to pick which stock I wanted to get.
Yeah, I'm more of a risk taker, so I bought some Lin Energy around a couple weeks ago, and I may buy some more because they're actually one of the top hedged producers in the whole world. They have a really good management. They were one of the few management teams who, when the natural gas price I think was at 16, when it was at 14 and 16, they actually hedged a good amount of their natural gas production for years in advance. And when the oil price, when the whole oil industry almost collapsed again in 2008, the Lin Energy had a lot of puts. They do a good hedging with their put trade. They have good energy and oil traders to protect themselves to generate cash flow. They had a good amount of puts, and they made like over $500 million trading puts in 2008. So they have most of their, I think most of their oil production is hedged at over $90 a barrel, or over $89 a barrel. Over 60% of their oil production is hedged for at least like 3 or 4 years, something like that. So I think they can muddle through. They may have to cut the distribution, but they're not going bankrupt. This is a really well experienced management team who's been through different down cycles. Unlike some of these shale oil producers, the regular guys, I think they took advantage of cheap debt, this artificially cheap debt from the Fed. And some of these guys were barely hedged at all, and some of them weren't even making a profit when the oil price was much higher. So they're either going to have to sell out or they're going to go bust soon, and then their oil production is going to come offline.
Yeah. Well, actually, another good thing another good opportunity is frac sand. A lot of their balance sheets barely even their stocks have gone down like 30-40%, but their balance sheets are practically almost the same.
You mean like a U.S. Silica or
Yeah.
Carbo Ceramics? Those are the regular C corps, and then there's like High Crush Partners for MLP, and there's one more Sand MLP. I forgot the name. ENES maybe, I think.
Yeah, Emerge Energy Services. I don't know much about them, but I read about them. They're doing pretty well. So the frac sand companies are doing pretty well right now. Their balance sheets look practically almost the same, but they're 40% cheaper. So.
Yeah, like I'm not going to make a prediction for oil prices, except that it's not sustainable for the oil price. Maybe it'll go lower in the short term, but it's not sustainable for the oil price to stay at these levels, given real world demand for oil, and the fact that Mo said, these governments need to balance their budgets. So that's something. It's just like the gold and silver miners. Can't tell you exactly when, but something's got to give. In the meantime, if you do your homework on these companies, or you buy an ETF like what Rahul did, if you don't want to actually do your homework, you can get paid to wait, and you can make some pretty good return in this market compared to so many other industries.
Another thing about oil is, if you guys remember in 2008, the price of oil went to $145 a barrel, and a lot of people were saying, hey, that was upside manipulation. This is what usually happens in futures markets. You tend to see prices, if they hit a certain level, they continue to go in that direction. And we're, in my opinion, at the same point right now with the oil price. So a lot of people think that, hey, $30 a barrel sounds crazy, but I don't think it's going to happen right now in a straight line, because the dollar has been on a tear and it's due for a correction. But I wouldn't be surprised if we see $35 to $40 a barrel sometime next year.
I wouldn't be surprised either.
There's real world ramifications. How long would it stay for that? For a month? For a week? Because those prices at 35 or 40, you're looking at the Saudis like experiencing potential civil unrest, maybe an Arab Spring, because they cut social program spending by 60% or more. You're looking at potential civil unrest in Iran or Iraq or Nigeria, or Venezuela obviously is a basket case, but that's more because like Marxism and socialism, and they've been not allowing any investments into their country, so that they're going through the predicted course. The lower oil price is just an effect of the lower oil prices may be the nail in the coffin for Venezuela, but my whole point is that all their causes have been based on socialism and Marxism, that they don't have a diversified economy, they haven't allowed investment into their own country, so people can make a profit and reinvest into the economy there and create value and jobs and small businesses and things like that.
Yes, lower oil prices. I think oil.
We may get a spike. We may get a spike low, Rahul, where maybe there's a blow off spike low where it goes to 35 or 30, maybe for a week or a month or something like. I don't see it staying down there because based on my opinions, and people can read these again if they email us Wall Street for Main Street at Gmail. I'll email them to you, no problem. 10 pages of my thoughts on 2015. I don't think the economy can survive oil prices too high or too low. So we're in a situation here where the producers of the oil need a certain price, and the consumers can't afford oil too high. But if the oil price is too low, no one can produce it at a profit. Yeah. So, and yet people still consume massive amounts of oil. I think we're still consuming over 90 million barrels a day of oil, despite the oil price dropping. Actually, probably we're going to consume even more oil than that, because the U.S. is probably going to start selling it. The car sales are going to sell more SUVs. Yeah. So people are going to buy more they're going to buy more gas guzzlers, or go back to the people who maybe at the margin who weren't going to go on a trip. They're going to start, paying for tanks of gasoline again. So we're going to hit a bottom because of that. And the rig count's also dropping, starting to drop rapidly. The rig counts also besides the CapEx drops John mentioned, which are tied in with the rig count, the rig counts are starting to drop fast now on onshore.
Yeah. And I just wanted to add one thing, because I wanted to look it up, but since you brought up U.S. Silica, their net income on a year-over-year basis after quarter three has increased from $21.3 million to $41.3. And
it's a good company.
So how did that go from? Go ahead.
And there's a lot of frac sand companies that are doing well with actually a better balance sheet, yet their stock's 40% higher. So 40% lower, I mean.
Anything with oil or energy related, Rahul, has been just mercilessly punished. I think a lot of the solar stocks are down as collateral damage to oil being down, because the view is that with oil prices being down, that there's not as much need for solar and other forms of energy. But the fact of the matter is that in many states now, people are buying solar panels because the cost of them has come down, and they're putting them on their house to supplement their energy bill. And that's a long-term trend that I think people should consider. Now, obviously, some of these solar companies have gotten subsidies and things like that. The Chinese have flooded the market with cheap solar panels. I really don't want to get into that. Like, I'm aware of this, but the fact of the matter is that the cost of these solar panels has come down a lot. They're starting to generate some decent electricity. You can put a solar panel or two on your house, and you can make a couple $100 a year, lower your electricity bill. People are considering this. So there's a growing amount of people doing this, and there's investment opportunity there. So I'm not saying solar is going to replace oil or natural gas or nuclear. I don't think any of that stuff's going to happen in the near term. But as a supplemental thing, you're going to see more solar panels on houses and on office buildings and parking lots and stuff like that. It's guaranteed with how much the price of these panels has come down and how they've improved a little bit.
Yeah, the installation cost for installing solar panels has come down 60% since 2011. So they're becoming more and more affordable for people on mainstream that want to put solar panels on their homes as well. And also the solar panels are becoming a little bit more energy efficient as well. So I agree with you on that.
Yeah, I think, Rahul, a lot of the problem with why these oil markets sold off so much is these computerized trading programs, is that people aren't necessarily discriminating as much as they should from company to company. And John named you an example of a company that shouldn't have gotten punished as much. Yeah. But I think almost anything with oil in its name has gotten just ridiculously punished. And I don't think – I think the baby – the main Wall Street analogy they use is, baby gets thrown out with the bathwater. But I think the market hasn't discriminated as well as it should. There's a lot of quality companies there in different parts of the oil patch, if people do their homework, that are still doing pretty good even at low oil prices. So there's a lot of them without naming any more names.
So let's shift gears here and talk about another commodity that we discussed earlier, which is the precious metals market. Let's talk about that just for a short while, then we'll go talk about other sectors. So for precious metals markets, I'm going to reuse my prediction from 2014 for the gold and silver market. I believe we'll see some upward movement in this market. Despite the manipulation in the paper market, there's no way these prices can stay low forever with a high demand and tight supply. So eventually the physical market will win the tug of war and push the prices higher.
Yeah, I personally think we should see upward movement this year. I think we will, despite the manipulation, just because it's been a really long, painful correction. And with the miners, they've never had historically 4 down years in a row. So I personally think it should go up this year, and I think one of the catalysts is when the Fed doesn't raise interest rates. I think right now the market's factoring an eventual rise of interest rates because of the U.S. economic recovery. I think, well, not only that, just the expectations, like the GDP growth was 5%. I put GDP growth in quotes because we don't really know what the real number is. But
the GDP is not really growing, John.
Yeah, I know. That's why I said it in quotes.
My food bill, guys, has gone up a lot since 2005 when I got out of college. So, I mean, there's still Obamacare premiums are up. How many more examples of inflation do you want me to name? And yet the Keynesians refuse to acknowledge any of this.
Oh, yeah.
They're statisticians. So we have a weird type of stagflation going on now. Maybe there's deflation in certain things. There's clearly inflation in others. Some people would say there's inflation and deflation going on at the same time. I wouldn't disagree with that, depending upon what your definition is. But, I mean, there's asset price inflation. A lot of the inflation has been exported to the developing countries. There is inflation here in the U.S., and Japan and Europe, but not as much as in China or Russia or Brazil.
Yeah, so I personally think when they don't raise interest rates, there should be some sort of bounce or rally, but who knows?
Yeah.
Okay, well, we're almost at an hour 10, guys. So rather than cover any more topics, let's just give everyone a couple minutes or so for closing final thoughts. And if people want to read all of my my analysis, my predictions or observations for 2015, they could just email me. Any more things you guys didn't wanted to mention and didn't?
Yeah, let me just mention my predictions, what I see for next year. You're starting to see problems in Russia right now. China's continuing to slow down, and you're seeing the return of volatility, in my opinion. We saw the VIX hit a low of around 10.61 in the summer of this year, right around the time where Bill Gross was betting with selling insurance through his firm that VIX or volatility would stay constant for the next 3 to 5 years. That looked like a contrary indicator. So for 2015, I expect to see more volatility, and as a disclosure, I am long volatility by shorting the XIV.
Well, I had 5 predictions for 2015. I already talked about 3 of them. Oil prices going sideways. We'll see some more upward movement in the precious metals market. I don't think the Federal Reserve will raise rates in 2015. My 2 other prediction is in regard to the technology sector. I think that sector will continue to advance and continue to amaze everybody with the advancement that we're seeing in that sector. But I don't know about you guys, but a lot of the technology that are coming out is starting to become more like the Terminator movie, where we're seeing a lot of robotics and the artificial intelligence is starting to become more and more advanced, where these machines are becoming smarter and able to do things more efficiently like humans can. So we're seeing a lot of technology advancement in that area. And even though that Google Glass look like will be a failure, there's other wearable gadgets in the pipeline that are interesting and could be a game changer. One of the biggest trends I saw from 2014 are gadgets to monitor like blood pressure, pulse rate, sleep cycles. Also for people with diabetes, they can also smaller, more efficient technology to measure their blood sugar. So also there's also technology coming forward where they can diagnose illness and even cancer at an early stage. And then also there's 3D printing, which is starting to become more starting to advance and become more and more efficient and start to create more and more different things. In 2014, we've seen 3D printers create organs. We've seen them create a lot of other different things as well. So I think that industry is here to stay. And we also saw Bitcoin become more popular in 2014 as well, when the prices spiked all the way to 1,200 before coming crashing down. So I think the digital currency movement is going to continue to gain momentum in 2015. Excuse me. Is Bitcoin going to be the main player? We'll see. But I think the biggest thing here that the blockchain technology that we just discussed frequently in 2014 will continue to be utilized for other things in 2015.
Well,
so I think that's going to be something that people should look into for 2015. And one other prediction I have, and this is a wild card prediction. For base metal, I'm bearish on most of them except one base metal, and that is zinc. And that's mostly because of the supply side fundamentals. The main reason for that is a lot of the larger mines are going to be shut down in 2015. One of them is the Century mine in Australia, which is going to be shut down in 2015. Another mine in Ireland also is going to be shut down in 2015. And also the global stockpile are shrinking. The Chinese are increasing their purchases for zinc now that car purchases in China is starting to increase, and as more and more Chinese are starting to buy more cars, so they're starting to buy more zinc because of that. And with the tight supply, I think the price of zinc will increase in 2015. So that's the only base metal I'm bullish on for 2015. So those are my 5 predictions for 2015.
John, any closing comments from you? Any predictions about 2015 or observations?
Not too many, as I think the stock market should be due for another correction, but I think it's probably more the same. I think they're going to do whatever they can to keep the stock market and bond market afloat. The correlations, I think, have been changed in terms of, like, gold used to go up with the stock market. In 2011, that changed, and I think over the next couple of years, that the correlations for the next crash where the resource sector will benefit, I think that's already been made over the past couple of years. The only, I echo what he says about zinc. I think zinc will be in a multi-year bull market because of a lot of the mine closures and supply deficits that will occur. I think their yen will just probably continue to depreciate. And one thing also about Japan is they started 4 nuclear reactors last year. I think the slow pace is going to continue because even though it's very politically unpopular, the only way they can have independent baseload electricity is through nuclear power. So they'll be forced to restart it, but they're going to do it slowly because politicians don't want uprising. So.
Yeah, those are some good predictions. If people want to read my work more in depth, and I think I discussed a good amount of it already, but I have a lot of stock pick ideas, not necessarily individual companies, although I do give some away, like Orbital Sciences, which is a space company, a rocket company. Their stock dropped a lot when their unmanned rocket that was going up to the International Space Station blew up, and that company's still profitable, and they're going to be one of the future leaders besides SpaceX, which is not publicly traded, helping create a space industry, a legit space industry, free market one here in the United States, and going out to other space exploration, maybe space travel, maybe space mining. I think Orbital Sciences will be involved in it. They're profitable right now. They've been around, I think, since the 1980s. That's just one of the ones I have in my template. Wow. So you guys can email us, wallstreetformainstreet@gmail.com. A couple more closing comments. We have, I think, 6 more days left till January 5th on the crowdfunding on Indiegogo. We're up to around $2,800 almost raised. We'll still take more money if you guys want to give it to us so we can continue to improve the website, the quality of our podcasts, et cetera, et cetera. We thank everyone who's already donated, and we're excited for 2015 for the prospects of our company and the excited things we have. And we're working diligently on getting the investor dollars to really start doing amazing things with the company and turning it into one of the best investor education companies out there going forward. And I'm also working on another project on organic farmland, real estate investment trust for the retail investor, but things are going a little bit slower than I like right now, but I don't want to give up on the project. I'm hopeful that we can move forward here because I think I found a good partner to help me out with that. And I'm excited to see those things out there because I think we clearly still do have some inflation, especially in food prices. And the retail investor can't afford farmland should get some type of exposure to organic farming. I think it's very profitable. Well, thank you everyone for listening to this. We're almost at hour 20. Thank you, Rahul, for joining us. Merry Christmas and a Happy New Year. And Happy New Year to you too, Mo and John. And I wish everyone a healthy, happy, prosperous health before wealth in 2015.
You too.